Welcome to the video version of the ebook Leading Practices in Treasury. This ebook is produced by Strategic Treasurer, a leading treasury consulting firm, and CTM File, a prominent corporate treasury news site. To download the ebook, please go to strategictreasurer.com/practices. Let's begin with the table of contents. The first section introduces the leading practices in Treasury. Section 2, Process Mindset. Section 3, Bank Relationship Management. 4, Bank Account Management. 5, Bank Account Architecture. The first part focuses on cash concentration. Section 6, Bank Account Architecture. The second part emphasizes pooling. Section 7, Cash Forecasting. 8, Compliance. Section 9, Leveraging Networks. 10, Strategies for Unforeseen Challenges. And 11, About the Firm's Strategic Treasurer and CTM File. Section 1, Introduction. This is the second ebook in the Professional Development series. The first installment covered foundational concepts, mindsets, and priorities for professional excellence in treasury management, drawing heavily from the popular Becoming a Treasurer podcast series from Strategic Treasurer's Treasury Update podcast. This second installment delves into leading practices for Treasury's daily tasks. For practical, focused recommendations and considerations of several of the most vital parts of the Treasury function. Continue watching. This ebook is based on a series of articles on leading practices originally published on CTM File. For more detail on these topics and for daily news and insights on what matters to Treasury professionals, we encourage you to visit www.ctmfile.com. Section 2, Process Mindset. In this audiobook, we will cover processes such as bank account management, relationship management, liquidity structuring, forecasting, compliance, financial messaging, and more. Some of these processes overlap with one another, while others contain many tasks within a single process. With so many processes, it seems best to begin with leading practices for managing processes overall. The first element is approaching processes comprehensively. The core leading practice for processes is approaching them comprehensively with an eye to the larger picture. No worthwhile task or process exists in a vacuum. Each task that Treasury performs is part of a process, and each process ties into others and eventually into the larger missions and needs of the organization. When carrying out or seeking to improve any process, Treasury must approach the process as a whole. This may require looking beyond a single department and recognizing the impacts of a process on working capital, liquidity, AP and AR, compliance, suppliers and vendors, sales, and so on. Broadening the focus beyond immediate control areas prevents sub-optimization and identifies larger risks and opportunities. The second element is efficiency and working capital processes. For Treasury, this mindset applies not only to its own processes, but also to how it advises and leads other areas within the company. As the owner of working capital, Treasury is often involved and should be involved in efficiency improvement efforts such as payment processes within AP. Here, part of Treasury's task is to promote an end-to-end approach to payments processes, an approach that takes into account other internal areas of finance, overall organization liquidity needs, and what is needed to support the supply chain. One leading practice for carrying this out is to form a working capital council or leverage it if your company already has one. This group brings together representatives from every area that impacts or is impacted by working capital to discuss problems and potential solutions, identify and drive out competing KPIs, and set up new KPIs and objectives. Treasury typically chairs the Working Capital Council, demonstrating its role in helping to foster a more integrated process mindset throughout the company. Both within the council and in other contexts, the treasurer must remind others in the organization and within Treasury of the importance of what goes on upstream and downstream of their processes. The third element is processes and technology. Technology is becoming an increasingly important part of Treasury, both as a tool for Treasury's daily tasks and as a consideration for improving organizational efficiency in areas that can impact liquidity. When approaching technological selection, implementation, and use questions, Treasury should maintain a process mindset. This plays into integration of various solutions within and across departments. Solutions that assist with different parts of a single process or that hold information required for another process must facilitate the progression of processes or information rather than hindering them. In financial processes, straight-through processing or STP refers to the ability of a financial process to continue without manual intervention throughout the various departments involved. While too narrow of a view can lead to a lack of needed automation or to trying to automate a small piece of a process without reference to how it will impact the whole, the broader process view referred to in STP enhances efficiency. While tools are often crucial, success in a process mindset is evidenced by demonstrable improvements in organizational performance. Treasurers must foster a mindset that aligns with an organization's strategic objectives and garners support from executive management. A process-centric view encourages measurement-friendly practices, motivates productivity, and embraces innovation. Section 3. Bank Relationship Management. The management of many aspects of the company's banking falls naturally under the cash and liquidity stewardship role of the treasurer. Banks are vital allies in a treasurer's cash management efforts, and the company's relationships with its banks can have significant impacts on liquidity, access, costs, and more. While bank relationship management may not sound like the most exciting part of Treasury, an excellent treasurer must recognize its importance and its potential as an avenue for improving the company's short and long-term liquidity situation. Treasurers must consider what banks provide. Banks are important providers of capital, credit services, and security. Many factors control how well banks can provide all of these things, however. Some of these factors have to do solely with the bank itself, as different banks provide different services and offerings, have different policies and fee structures, and may present more or less counterparty risk. However, some of the value provided by banks is determined by the strength of the relationship itself. A corporate client who makes themselves important to their bank by, for example, maintaining large balances is in a better position to gain credit at good rates from that bank. Thus, the task of maintaining bank relationships becomes an important one that can deeply impact liquidity. The treasurer must consider which banks should be prioritized and how best to handle the relationships of both the more and less prioritized banks. Here are the leading practices for managing bank relationships. There are several important considerations and leading practices for bank relationship management. Most of them are aimed at maximizing what you are getting from your banks rather than taking a simply good enough approach, and at supporting longevity in the relationship by tracking details and preventing the relationship from hanging entirely on one person at your company. The first leading practice focuses on share of wallet. The leading practice of calculating how much share of the company wallet each bank has is aimed at giving companies a clearer view of how important they have made themselves to each bank. This allows for a better understanding of where they stand and what could be changed to make you more important to the banks that are most important to you. Second is scorecard. While share of wallet exercises allow you to see how important you are to your banks, scorecards help identify how important a bank is or ought to be to you. Making scorecards involves rating your banks on the positives and negatives of working with them and allows for improved feedback to each bank in addition to a better internal understanding of their importance. The third practice is centered on communication. Transparent and frequent communication between a company and its banks is essential for business continuity and growth. Mutual updates create a symbiotic relationship with corporates sharing business strategies, enabling banks to tailor their offerings and inform Treasury of relevant developments. Formally document calls and meetings with your bank and try to involve more than one person from your company in bank communications. The goal of these efforts is to allow for continuity and prevent a situation where one person leaving your company requires a complete rebuilding of banking relationships from the ground up. Leverage your bank's expertise is the fourth practice. In addition to extending basic banking and credit to their corporate clients, banks offer many advisory and payment security services. These offerings may vary from bank to bank and needs vary from company to company. Examine your needs and communicate with your bank to understand their current and planned services. Leverage what they can provide as suits your individual company needs. Section 4. Bank account management. Beyond managing bank relationships, Treasury must also manage the accounts at each bank. Bank account management, or BAM, involves the opening and closing of bank accounts, the management of bank account structures, which will be discussed in more detail in later chapters, and the use of bank services for accounts. Its execution carries significant implications for better or worse, for visibility, control, flexibility, and more. The first vital area is visibility concerns. It is difficult to protect or properly manage what you cannot see. Visibility into all accounts allows for better planning and more rapid identification of fraudulent activity. Catching fraud early raises the odds of getting the funds back or preventing further fraud, and daily or real-time visibility enables Treasury to improve liquidity and overall risk management. Despite its importance, many companies lack bank account visibility that is sufficiently timely or sufficiently comprehensive. According to Strategic Treasurer's 2021 Cash Forecasting and Visibility Survey, 18% of respondent organizations discovered active bank accounts in the previous 2 years that Treasury had not been accounting for. In the same survey, only 35% of respondents reported daily visibility into all of their operating bank accounts. Security concerns represent the second vital area. The impact of BAM on visibility is deeply tied to fraud prevention, but attending to bank account management also impacts security when it comes to the bank services and controls that set parameters around accounts. These include debit filters and blocks, block and allow lists, electronic pre-authorizations, positive pay, and more. The third vital area is operational concerns. Bank accounts must also support the company's operational needs. Depending on their specific situations, and those situations may shift over time, organizations need certain extents of flexibility, scalability, global reach, and so on. Security and visibility are not places to compromise, but as you seek to implement the leading practices outlined below, make sure to consider what your operational needs require of your bank account services and structures. Here are the leading practices for bank account management. First, inventory. Perform an inventory of bank accounts to ensure that Treasury is aware of and accounting for all of them. Second, automation. Transition to automated processes for daily or real-time visibility across all accounts, legal entities, and banking relationships. Unless complexity is low, manual processes are too slow to facilitate daily visibility. Third, rationalization. Rationalize accounts to reduce complexity, improve efficiency, and streamline your account structure. And fourth, leverage needed services. Stay informed about the services your bank offers for account level and transaction level controls and other services that relate to BAM. Consider your company's needs and add or remove services as needed. Too little time for bank account management. According to Strategic Treasurer's 2024 Treasury Perspective Survey, of the 46% of survey respondents who indicated they don't have time to perform all of their responsibilities, 33% noted relationship management as one of the responsibilities they lacked time for, and 25% selected compliance and bank account management. Section 5, Bank Account Architecture, Part 1. This focuses on cash concentration. In addition to managing the accounts themselves, Treasury must also take an intentional approach to how those accounts are structured. Bank account architecture can be used to improve efficiency, visibility, and security. A basic structure generally recommended for its benefits in each of those areas is a concentration structure. In this structure, there are 3 types of accounts. First type is collection accounts that receive deposits. No disbursements are made from these accounts, and money should only flow out of them into the concentration account. Second type is disbursement accounts that only disperse payments. Funds only enter disbursement accounts from the concentration account. And the third type is the concentration account that funnels funds between the collection and disbursement accounts. This structure, where cash flows into the company through one clear set of accounts, is concentrated in one account and from there is transferred to dedicated disbursement accounts, has several advantages. Dual objectives: mobilizing funds for efficient cash management and isolating specific activities guide the design. This method of structuring accounts offers centralized visibility, aiding decision-making for investments or debt repayment. With the concentration structure, the organization's fund movements are more predictable, which has the added advantage of making errors and fraudulent activity more obvious. Any disbursements from a collection account, for example, are clearly suspicious. In addition, concentration accounts make it easier to see the organization's net for the day. This categorization of accounts can be extended further as well. Many companies find it useful to use separate accounts for different types of disbursements, ACH versus checks, for example, once again increasing clarity and making anomalies more obvious. This separation can also allow for controls such as filters that block disbursements that do not match the specified transaction type. For example, a filter might be put in place that would prevent ACH transactions from pulling from a specified checking account. Section 6, Bank Account Architecture, Part 2. This focuses on pooling. The basic goals of cash concentration can be accomplished in a handful of different ways, including physical pooling, notional pooling, and short-term investment pools. Which should be used depends on a company's geographic location, industry, and more, but treasurers should be aware of all of them. First, physical pooling. Automated physical pooling is the method that most straightforwardly concentrates cash. It involves the centralized transfer of funds from diverse bank accounts to a single concentration account, consolidating liquidity and mitigating risks. This can be done using zero balance accounts or ZBAs, which are automatically zeroed out daily by moving any funds to the concentration account and which only have funds transferred into them for specific, immediate purposes. Sweep accounts, which function similarly to ZBAs and may have preset target balances above zero, can also be used. Adoption of an automated physical pooling structure makes it possible for the system to take over and move cash when required. This automatic cash movement presents to the corporate treasurer a consolidated view of a corporation's cash position that aids in lowering borrowing costs, reducing the need for external debt, optimizing interest and working capital, and avoiding a liquidity crunch during uncertain market conditions, said Craig Jeffrey, managing partner at Strategic Treasurer, a leading treasury consulting firm. Organizations with subsidiaries or operations in several countries can concentrate the cash in one spot for improved visibility and availability, reduced fees, optimized interest and working capital, and debt paydown. This type of physical pooling works best with companies that have a centralized cash management structure to balance the accounts of a group's subsidiaries and efficiently pass down funds to those parts of the organization that need them. Second, notional pooling. Although it is not allowed in the US, in regions where it is permitted, notional pooling can be helpful for corporations with decentralized treasury structures or highly autonomous subsidiaries that prefer cash to be in local control and not commingled in a physical concentration account. With notional pooling, a bank notionally combines a company's account balances without physically combining the accounts. It allows for many of the benefits of cash concentration without sacrificing regional and entity autonomy. Exactly what can be gained by notional pooling depends on the bank. Some now offer multi-currency, cross-border notional pooling solutions that enable corporations to use their cash value globally without the need to move funds across borders. This enables them to better leverage the aggregated net balance in multiple currencies, sometimes done without converting currency, that helps avoid foreign exchange costs and optimize interest payments within the group. In many cases, the organization may be able to access the total pool of funds in any country, whether or not the funds are physically located there. This reduces interest expenses or interest spreads, and if the debit balances are fully or partially offset by credit balances, the corporation receives higher interest income. An automated notional pooling structure lowers the costs of borrowing, minimizes total borrowing needs, and helps address cyclical cash flow fluctuations. Notional pooling is treated as a form of bank lending, and as a result, the pool holding bank will require cross guarantees and full legal write-off, balance set-off, and interest set-off over the pool accounts. Notional pooling structure is more complicated than physical pooling and is practiced in major treasury center locations such as Hong Kong, Singapore, London, and various European countries. In the US, notional pooling is not allowed by the Office of the Comptroller of the Currency. Third, insurance short-term investment pools or STIP. Tailored for insurance companies, STIP structures automate the mobilization of liquid cash to efficiently manage various portfolios and business lines. Consolidating cash in one pool facilitates larger strategic investments, reducing transaction costs, increasing yield, and simplifying investing processes. Insurance companies have large investment holdings to support their various liabilities. These liabilities often cover different durations and are managed in different portfolios. Each portfolio has current liquidity needs, whether to cover operational insurance flows or to provide liquidity to support investment purchases. When each asset and liability stream is managed separately, a lower yield may be achieved on the investment portfolios. With this tip, the cash is typically pooled in one spot to facilitate the purchase of liquid and highly rated short-term investments or securities. The pooling of balances allows for larger purchases, greater liquidity on any given day, higher quality investments, and the margin sought by insurers. Section 7. Cash forecasting. Cash forecasting is a vital but frustratingly time-consuming task for many Treasury departments. Understanding the situation and needs for forecasting and following the leading practices at the end of this chapter may help a Treasury department's forecasts to be less painful and more effective. Let's first consider types of forecasting and their purposes. Treasury's primary interest is with the short-term cash forecasts that can help them with more imminent cash management and liquidity planning, but controllers are interested in long-term forecasts. Longer-range planning that is oriented toward the income statement is also highly important to the organization, and while Treasury must keep the focus of its own forecasting on the short term and the balance sheet, it must also do what it can to facilitate the controller's forecasting needs, as these are ultimately organizational needs. The first purpose of cash forecasting is speed. There is little use in a weather forecast that only tells you it will rain after you have already left without your umbrella. Cash forecasting must also be timely, allowing enough time for Treasury to plan and act. However, the forecast relies on information from multiple sources. If all the necessary data lags or if it cannot be quickly accessed by Treasury, the forecast may also lag. Even if the data is accessible in a timely manner, Treasury staff often find forecasting to be a particularly time-consuming task. As a result, increasing efficiency in forecasting is a priority. Accuracy is the second purpose of cash forecasting. Another useless type of weather forecast is one which, however early, tells you it will not rain when it will. While a cash forecast can never perfectly predict the future, certain levels of inaccuracy make the forecast effectively useless. As a result, improving the accuracy of forecasting is another priority. Here are the leading practices for cash forecasting. Keep in mind that each company's needs for forecasting differ, and your level of complexity may impact how these leading practices apply to your situation. By and large, however, these are good steps to take for improving cash forecasting. First, testing and variance analysis. The accuracy of your forecasting must be assessed and improved on an ongoing basis. Testing your models, whether in sample or out of sample, ensures that they represent reality. Running multiple models at the same time to see which ones work better in different what-if scenarios, fall in sales, increase in demand, debtors extending payment times, and more, provides useful comparisons and leads to more insights. In addition, variance analysis can be used to investigate discrepancies between each forecast's predictions and the actual outcome. Review variances frequently and track down the sources of large variances more urgently. The second leading practice is leverage technology. Automation tools and technologies such as artificial intelligence and machine learning are empowering higher levels of speed and accuracy in cash forecasting than were previously achievable. While the use of regression analysis and other statistical models has been and continues to be helpful, machine learning and artificial intelligence can help analyze more of the multitude of microfactors that impact cash flows, resulting in less strain on staff and, especially as the technology improves, more accurate forecasts. Various other technologies such as application programming interfaces or APIs for bank connectivity and other automation tools can also help reduce the time staff must sink into tasks and allow for more timely forecasts. Not all tasks lend themselves to automation, but data collection, aggregation, and formatting do. Transforming these portions of the forecasting process from manual to automated can make a massive difference to the accuracy and timeliness of the forecast, leading to staff armed with better, more timely information and more time to strategically analyze how to respond to it. Third, using historical data effectively. When available, the use of historical cash flow data in forecasting can be very helpful, but its applicability should be carefully considered, not assumed. A company that experiences similar volumes and cycles of sales year after year, for example, may gain useful insights from its historical data, but a company whose sales fluctuate dramatically from year to year may find it difficult to base any predictions on past performance. All companies are subject to the effects of external economic forces, but some are more impacted than others. Your use of historical data should be appropriate for the level of variability that can be anticipated for your particular organization. Even for those that are comparatively stable, room should be left for shifts, both anticipated and unanticipated. The fourth leading practice for cash forecasting is communication and major items. Treasury must account for major one-off transactions that can significantly impact cash positioning, either positively or negatively. These one-time items can arise from various departments and may not be standard expenses or appear in the financial statements until it is time to make a payment. In order to hear about these items well ahead of time, Treasury must keep clear lines of communication open with the various areas whose actions can impact cash. Section 8. Compliance. Most regulations that impact Treasury are put in place to mitigate systemic risks of economic upheaval and fraudulent or criminal activity. Since these factors show no signs of decreasing, it must be assumed that the regulatory environment will likely hold steady or increase. Treasury's compliance concerns primarily revolve around banking and payments. While compliance may not be a top-of-mind task for many treasurers, it is nonetheless vital to managing risks and avoiding fines. The following are several of the regulations that treasurers are most concerned with. First, Know Your Customer or KYC. To comply with KYC, banks require certain information from their corporate customers, and Treasury is responsible for providing much of this information. Second, Report of Foreign Bank and Financial Accounts or FBAR. Companies with bank holdings in foreign countries that exceed $10,000 at any point during the year are required to file FBAR to report all foreign bank account holdings and signers. Third, Beneficial Ownership Information or BOI. BOI requires certain companies to divulge certain data on those who file the paperwork to form the entity and those who financially benefit from it. Fourth, Payment screening. OFAC and other regulatory bodies maintain sanction lists of groups and individuals connected to criminal or terrorist activity. While many companies rely on their banks to screen their payments against all relevant sanctions lists, there have been instances of heavy fines laid on corporations for negligence in sanctions screening. Fifth, security and controls. Payment networks reduce the risk of their platforms being used fraudulently by requiring certain security measures to be met by all of their network participants. SWIFT's Customer Security Program or CSP is an example of this. PCI DSS is another regulation issued by the payment card industry, which requires certain security measures of all companies that collect, transmit, or store customer payment card information. Here are the leading practices for compliance. First, assign clear responsibilities. In order to carry out compliance activities well and keep track of changes in the regulatory environment, individuals should be assigned clear responsibilities. This prevents duplication of activities and enables demarcation of risk ownership. Each individual should understand their duties not only to carry out current compliance tasks, but also to track new and potential regulatory changes. These individuals should be able to feel a clear responsibility to monitor whether the company is meeting the requirements for applicable policies, controls, risks, processes, and standards, and report possible violations. Second, conduct regular meetings. Hold systematic compliance meetings quarterly or semi-annually where the individuals tasked with compliance responsibilities report on their progress and share any new information or concerns that have come up. These formalized meetings serve as a platform to address compliance issues, increase understanding, gather feedback, and secure leadership commitment to compliance. Section 9. Leveraging networks. The networks Treasury uses typically provide any of the three advantages: information, outsourcing, and security. Many unique networks have appeared in recent years, helping with everything from vendor validation in payment systems to KYC assistance. The most common networks Treasury will work with, however, are for financial messaging. While these networks do not directly transfer funds themselves, the information and payment instructions they convey between transacting parties and their respective banks is a vital component of the payments infrastructure across the globe. Leveraging networks well offers increased visibility and efficiency. Different networks offer different levels of functionality and visibility, but as far as financial messaging networks are concerned, there are limited options available in each region. Many regions have their own specific networks such as ebook in Europe and Zenjin in Japan. Swift is the dominant global network. Swift's functionality has advanced from linear messaging to a platform system that allows greater visibility throughout the payment process and reduces the chance of errors. In addition, the network offers some assistance with KYC compliance. Here are the leading practices for using financial messaging networks. First, reach and functionality. Treasury should recognize that leveraging networks can bring significant value to the organization. This value is determined by two factors: reach and functionality. Reach refers to the number of and type of participants on the network, while functionality refers to what the participants can use the network for. Both are necessary and both should be carefully considered when Treasury seeks to assess the value that a network would bring to its organization. Second, seek resilience. With so much depending on financial networks, and since they handle payment data and other confidential information, they must be held to a high standard. A network should have strong security measures in place. In many cases, a network may be only as secure as its participants, leading to security requirements for participation. Resilience also requires high uptime measures, multiple levels of redundancy and failover, and may mean sitting on a separate, secure network rather than relying on the mainstream internet. Section 10. Strategies for unforeseen challenges. As managers of liquidity risk, treasurers are tasked with preparing the organization to survive both the turmoil that can be anticipated and that which cannot. This is not an easy task. Preparations for unknown challenges will never be quite perfect, but this does not mean that nothing can be done. Certain steps can be taken to place Treasury in the best position to handle the unexpected when it inevitably comes. Leading practices for the unexpected. First, threat assessment and monitoring. The first step to preparing for the unexpected is to ensure that you expect everything that you reasonably can. Regularly review organizational liquidity challenges and assess the threats and impacts that can be foreseen. Keep policies current, diversify risk, and establish early warning systems for abnormal activity where relevant. Leveraging business intelligence tools and data analytics can help predict and prepare for anomalies. Second, be mindful of history. Pay attention to history. This goes beyond using historical data to make predictions of what is likely. It extends also to using history to better understand outlier events that happen rarely but do happen. While some amount of risk is inevitable, ensure that you do not ignore the possibility of the type of unlikely but highly impactful scenarios that history shows occurring. Third, margin will be necessary. While we may not know what crisis or turbulence may be on its way, we can know that whatever it is, Treasury will have to work quickly and strategically to help the organization weather it. To handle these situations well, Treasury will need margin. If your daily operations are already pushing the bounds of your staff's capacity, leaving you little to no time for strategic work, you will be poorly positioned when a crisis comes. Create the margin to handle the unexpected by working to drive out inefficiencies and by leveraging technology and automation to free staff for strategic tasks and rapid analysis in crises. The fourth leading practice to manage the unexpected is visibility. Visibility is another element that will prove useful no matter what type of difficulties appear. Timely access to comprehensive data on cash, investments, debt, and other liquidity factors can allow Treasury to respond quickly and appropriately to unexpected situations. This too requires efficiency and in many cases leveraging technology and automation. Finally, communication is the last leading practice for managing the unexpected. Lines of communication must be well maintained in times of stability so that volatility can be handled quickly, efficiently, and accurately. During unexpected events, treasurers must communicate early and frequently with parties ranging from the C-suite and other finance teams to bankers. Proactively communicate with senior management and the board and foster internal discussions for well-informed decision making. Section 11 about the firms. Strategic Treasurer was founded in 2004 by Craig Jeffrey, a financial expert and trusted advisor to executive treasury teams since the early 1990s. Through advisory services and research, they serve companies, banks, and fintechs across the globe. This team of experienced senior treasury advisors are widely recognized and respected leaders throughout the industry. Known for their expertise in treasury technology, risk management, and working capital, as well as cash management and banking operations, they efficiently identify issues, creatively explore ideas and options, and provide effective solutions and implementations for their clients. For more information, visit strategictreasurer.com. CTM File is a web-based news platform offering the latest cash flow, liquidity, payments, and working capital management news for treasury departments, cash managers, and finance directors. An outlet on the Treasury News Network, owned by consulting firm Strategic Treasurer, CTM File is intended to be a community where treasury professionals can learn and share. The platform includes editorials written by staff, content contributed by associate members and individual practitioners, industry roundups, and the Open Treasury podcast, where industry leaders discuss recent treasury news and developments. CTM File is based in the UK with a global readership. Thank you for your time. To download the ebook Leading Practices in Treasury, please visit strategictreasurer.com/practices.